Okay, Steph, a bit of a million-dollar question you're taking on today. How do we find the best growth stocks? I'm assuming once you've answered this, you can just retire, right?
Guy, my bag's already packed. The parasol is waiting for me at the beach. So, I'm ready to leave.
Well, for those of you listening, just keep that image in mind after learning today's strategy, right? Okay, well, retirement aside, we are talking all things growth stocks. And in your research, you've written about a pretty tried and tested method for identifying stocks that could be about to take off. This is the CAN-SLIM method, C-A.N.S.L.I.M. Steph, I love a good acronym. Break this one down for us.
It is a pretty good acronym, actually, Guy, at least in investing. And, it really works because it blends fundamentals, momentum, and timing. But more importantly, it's a full process. So it's not just a strategy. It's not just, telling you what to buy, but also when to buy, how much to buy, and when to sell. So what the hell is CANSLIM? I mean, in short, each letter highlights a trait that most previous big stock winners had or displayed before they actually took off, right? So let's start straight into the CAN-SLIM method. Let's start with the C, which stands for current earnings and sales growth. And it's probably the single most important piece. So you might want to pay attention to that part, Guy, because big stocks moves usually start with big earnings move. It's really that simple, right? So you're looking for explosive quarterly growth, ideally at least 25% EPS growth in the last quarter compared to the same quarter last year. Even better if that growth is accelerating. Sales growth matters too. It confirms that demand is real and not just the result of, cost cutting or some clever accounting tricks. You've got, of course, other green flags when it comes to earnings, like positive earnings surprises in the recent quarters, analyst earnings upgrades, and, a pretty strong forward outlook for earnings. So, look out for those too. Of course, you also have to, do your homework. And since you want clean numbers, you have to make sure to exclude one-offs and look to isolate, really repeatable operating profits. So that's for the C, current sales and earnings growth. Next up is the A, annual earnings growth. One strong quarter, of course, it's cool. It might grab attention, but it's really long-term consistency that builds conviction. So here you're looking for steady EPS growth of at least 20% a year over the last 3 to 5 years. Ideally, no dips. You just want some smooth upward momentum in earnings and sales growth. And, to filter out low quality or badly run businesses, O'Neill, the founder of the CAN-SLIM model, recommends a useful extra check, which is simply to screen for stocks with a return on equity higher than 17%.
Woof, 25% plus earnings growth in the current quarter and double-digit long-term growth in sales and earnings too. So, okay, unsurprisingly, these are some heavy hitters. I mean, what about N here? This is all about the new factor, isn't it? What does that mean?
Well, it seems like you know it already. N stands for new, and it's the spark that kicks off the next growth cycle. So, it could be a breakthrough product, it could be a bold strategic shift, it could be a new CEO, or, even a fresh IPO. Anything really that changes the narrative in a meaningful way. Think iPhone for Apple, think ChatGPT for NVIDIA, those kinds of big shifts and big shifts in narratives that can really get investors excited and that can drive stocks to go to new highs. And, it's not just the company doing something new, the stock should be doing something new too. Because ideally, according to the CAN-SLIM method, you want to see the stock breaking out to fresh highs on strong volume. So, most investors shy away from new highs. In CAN-SLIM, that's your confirmation that, the move is real. So, the bottom line is something has to change to drive a revaluation of the stock. New is what makes people reprice the whole story. So that's what the N stands for.
All right, Steph, what about the S? I mean, this one seems a little bit less obvious. What are we looking for there?
It is less obvious, and it stands for supply and demand imbalance. So, when a stock explodes higher, it's rarely just about fundamentals. So it's usually because, you know, a lot of people want in and there aren't enough shares to go around, right? So you've got this imbalance between, you know, strong demand and a limited supply. So, you know, when fewer shares are available for people to buy, you know, either because the company hasn't issued many shares or, you know, perhaps because insiders are holding out most of them, well, it takes less buying to actually push the price up, right? It's pretty economics 101. So, you know, that limited supply and that strong demand can, you know, cause the stock to move much, much faster when that demand arises. So, you know, look for a low share count, look for a tight float, look for heavy insider ownership. And, you know, there are other things like, for example, share buybacks that can also reduce supply even more. And they also signal a confidence from management. Generally, share buybacks are also pretty good for CANSLIM. And, you know, try to also find companies with low debt and limited dilution risks because they're less likely to flood the market with new shares later. So that's another plus when it comes to supply and demand. But the best clue, according to CANSLIM, that demand's heating up, that's volume. When a stock pulls back on low volume but rallies on high volume, that's a sign that, you know, some pretty big players are quietly loading up on the stock, that, you know, they're accumulating the shares. So, you know, O'Neill says, look for that typical pattern. And on top of that, look for a breakout, you know, with above average volume when prices are rising. That's really, you know, the kind of signal that institutions are stepping in.
Interesting. And what about L here? You've written in your research that this is about backing the strongest horse in the race.
Yes, so L is for leader, not laggard. You know, you want to bet on the horses that are already winning, guy. That means stocks that are doing better than their peers and better than the broader market. You know, you don't want to buy the stocks that are playing catch up or the stocks at the bottom of the pile. So, you know, generally the way the CANSLIM works to find those stocks is simply to look at relative momentum. So, you know, simply ranking all of the stocks in terms of their price momentum, price return over the last year, and trying to find the ones that are beating at least 85% of the other stocks out there. You know, another quick check, if you don't want to calculate relative momentum, is just to basically look whether the stock is near a new high or not. You know, leaders tend to hang out near their 52-week highs, while laggards tend to sit at the bottom, and that's generally because they sit there for a reason. So another very important thing actually is you want leadership at the sector level, right? So, you know, most big winners, at least historically, have come from strong industries. Right now, for example, you know, look at sectors like tech, financials, or industrials, because they're the hottest sectors right now.
Okay, so you want strong fundamentals, a fresh story, strong demand and low supply, and a stock already leading the pack. What's the I in CANSLIM all about then?
Yeah, so that's institutional sponsorship or ownership. You want to see the pros starting to build positions in the stock. So, you know, O'Neill originally looked for at least 20 institutional holders, but, you know, you don't want too many either, right? Because if it's already overowned, you know, the upside's limited. Everyone has already gone long on the stock. There's no more buying power left. So, you know, the sweet spot generally is around 10% to 60, 70% institutional ownership, ideally with, you know, high conviction growth funds starting to buy in, not just index trackers. And, you know, keep an eye on what's happening right now. If quality funds are adding in the latest quarter, that's a really strong signal that the stock is gaining momentum. So, you know, you also want momentum of that institutional buying. And it's not just about how many funds, it's who. A few top tier active managers, you know, of course, that's a lot better than, you know, dozens of passive ones.
Okay, and we finish on M. What's M, Steph?
M is for market. And honestly, it might be the most underrated, I would say, piece of the whole puzzle. And the idea is pretty simple. You know, even if you've nailed everything else, your stock probably won't work if the broader market's heading south, right? Like, I mean, you're buying highly risky stocks after all. So, you know, you only want to buy or even hold growth stocks when the overall market is in a confirmed uptrend. Now, of course, you know, spotting that uptrend isn't an exact science, but, you know, if markets are choppy and you're unsure what the trend is, O'Neill says that, you know, you have to look for some technical factors, like, you know, for example, a follow-through day, you know, where the market rallies on strong volumes a few days after a bottom, Or on the flip side, if you see a cluster of distribution days, big drops on heavy volume, that's a red flag. But I think, this is a bit wishy-washy to be completely honest. So, if you want a kind of easy shortcut, just look at whether the market's trading above where it was 1, 6, and 12 months ago. If it is, then, momentum is still going up. But, if it's lower on 2 or more of those time frames, then, I think that's a red flag that the trend might be turning.
Okay, so that's a pretty comprehensive process for how you pick the stocks themselves, right? But you've written that this is only actually half the process and that there's 3 other important points to consider here. When do you buy? How much do you buy? And when do you sell? So let's start with when do you buy here?
Yes, I would say that's even less than half the process because, when we talk to our users, they all want to know which stocks should I buy? Which stocks should I buy? But that's really, if you ask any very successful long-term manager, they will tell you that, it's not really important. It's important, but it's not the most important part is what you buy, but it's really, when you actually sell, how much you buy, etc. So all of those things, having a clear process is super, super important. So, let's start with timing. When to buy. So the golden rule in CANSLIM is only buy when a stock breaks out of a proper base. What does that mean? So there are different setups. The easiest one and probably the best one is called a cup with handle pattern. So, just picture a rounded base, that's the cup. Pretty easy to imagine for British, I imagine. That's the cup, where the stock pulls back. Then it finds support and starts to recover. Then comes the handle. So, it's kind of a short, tight dip near the top of the base. And that little pullback, that handle really shows that weak hands have been shaken out and the stronger investors, often institution, are stepping in quietly. And the actual buy signal, according to the system, is when the price breaks above the high of the handle, ideally on 40 to 50% higher than average volume. So, that really confirms that, the weak hands are out, the strong institutional investors are in, they keep buying, and, the big demand is coming in, and that's why, the price breaks out on strong volume. Now, there is a very important key point here, is that you only want to buy within 5% of that breakout point. If it runs too far, just let it go. That's fine. You'll get other opportunities. You cannot just chase overextended stocks because, it will lead to losses. Also, a very important, only buy if the overall market is in an uptrend. That's back to the M. But that's really important because even perfect setups tend to fail when the broader market's falling. So super, super important.
Yeah, you never want to have that tunnel vision, right? And what about the how much to buy part of this?
Yeah, so this is the one area where I have to say CANSLIM isn't super clear. So, that gives you a bit of more freedom. I think that's the positive thing. But, it can also make it a bit more wishy-washy and tricky. So, here are some guidelines. So first, you want to keep your portfolio tight. So, most CANSLIM investors will stick to 5 to 8, maybe 5 to 10 high conviction names. That's enough to kind of have some level of diversification and reduce, company-specific risk. But it also forces you to stay focused, which is very important because, this isn't a buy and hold strategy. You really need to stay on top of it. You need to be active. Then there's the golden rule. Risk no more than 1% of your total portfolio on any single trade. So, let's say your portfolio is 100,000, nice portfolio, guy. That gives you a 1,000 risk budget per trade, right? That's 1% of the 100,000, but that's not the capital you'll invest. That's the capital you can afford to lose on any one trade. So let's say you're buying a stock at $50 and you're placing your stop loss at $46, right? So you're risking $4 per share. Now you divide that $1,000 risk budget by the $4 stop loss, and it means that you can actually afford to buy 250 shares. That's the size of your position. Now, when you enter a trade, a good idea generally is to start with a half position, about 50% of that amount. And then if the breakout works and the stock holds up well, you can actually add the second half. If not, if it fails, your loss is smaller, and that's kind of an extra safety net. So I think this is a good idea, especially if you're new to the strategy. And, as you gain experience, And if you're in a strong trending market, you can go a little bigger than this, maximum 1% on any one trade. But, in choppy conditions, I think even if you're more experienced, it's really important to stick to that 1% rule to really kind of protect your capital and build discipline.
Okay. And finally, when to sell?
Yeah, so first rule, set a hard stop at 8% below your entry price and no exceptions. That's really important. That's a key part of the strategy because, it will protect you from false breakouts, which will happen more often than you think, even with perfect setups. And, just as importantly, it will also protect your portfolio when the market starts to turn against you. So, actually, when O'Neill did all of this research, he really found that, actually cutting those small losses quickly was really one of the biggest reasons why this strategy was so successful over the long term. And, I think I couldn't agree more, to be honest. The math is super simple. If your winner makes 5 times more than your losers, you only need to be right 20% of the time to break even. So that's why you have to be super aggressive when cutting losses, right? Like it will not only protect your capital and move on fast, but it will also allow you to be right at a lower percentage rate than with another strategy. Now, on the flip side, if a stock climbs 20 to 25%, O'Neill recommends taking partial profit. So, maybe sell a third or half of the position in that case. And now, of course, if you paid attention, so, you cut your losses at 8%, take profits at 20 or 25%. Now, what about that messy middle, right? Between a minus 8% loss and that 20% gain? Well, there's no strict rule here. And that's, again, I think a blind spot in the CANSLIM methodology. But this is where, you're supposed to use judgment and a chart. So, O'Neill recommends to look for breakdowns below support, heavy volume selling, climatic spikes, or signs that the stock is underperforming the market. So, sometimes you'll sell into strength, other times into weakness. It really depends on what the chart is telling you. Now, O'Neill was against using trailing stop losses, but I think they're extremely useful if you're new. It's just super hard to really interpret these charts in the way that O'Neill tells you to, right? So I think, honestly, if you're a more beginner, even using a basic 8% trading stops, trading stop is simply a stop loss that moves up as the stock price rises. I think this is already a very good idea to start with. And then, if you want another idea, potentially just use the 10-week moving average as a dynamic stop and, just exit when, that key support breaks. And one final thing, once again, make sure you always watch the broader market, because if the broader market is going down, if the momentum is turning on the broader market, you also want to, exit your position. That's really, really important.
Okay, so let's take all of this and put it into action then, because you've actually gone one step further and used this method to find stocks right now that you, our listeners, should be paying attention to. You've got this list here, but first, I'm curious about how exactly you found these stocks.
Yeah, I've actually had to do the work, guy. That was the fun part. But look, I started with a screen on Coifin, looking for strong and accelerating sales and earnings, not just right now, but over the past few years. Remember the C and the A, as well as, decent ROE, strong price momentum. I also used Finviz to dig into things like institutional buying, insider trades, floats, surprises, beats, and all of those things. So I've used both platforms, and I've cross-checked all of these breakouts with IBD, which is an investment platform specifically dedicated to the CANSLIM methodology. And, I've also used ChatGPT for the something new, right? So that's kind of what I used. The main takeaway of doing all this work is that CANSLIM is pretty powerful, but it's definitely not plug and play. EPS growth is actually very easy to screen for, but things like market leadership, supply and demand imbalances, or, product catalyst, and more importantly, how to read the chart, it all really requires actual judgment. So, I also learned that I've had to rerun screens very often, because if you miss just one data point, that can really block a great stock. And, it's also super important to understand the fundamental story. So, for example, I got super excited about this stock called C.A.N.S.L.I.M. I mean, it looked just like the perfect CANSLIM stock. But I realized it was just a bet on egg prices. So, I'm not sure that's the kind of growth narrative this strategy was built for. So, I kind of screened it out. So, in the end, I would say I manually reviewed about 50 names and narrowed it down to a few that really check most of the boxes and that are, near proper buy points.
Right. Okay. And I mean, what did you find?
Yeah, so here's what made the shortlist. So, these are the stocks that fit the CAN/SLIM criteria and are either actionable right now or getting very, very close. So the first one was LPL Financial. The ticker is LPLA. It's the largest US independent broker-dealer, and it's a direct beneficiary of advisors ditching Wall Street for higher payout, and more flexible platforms. Super strong CAN/SLIM profile, earnings and sales are accelerating. Price momentum is very strong. It sits in one of the best performing sectors this year, and it's right at a buy point. On the IBD platform, again, like the platform, like the official platform of the CANSLIM method, it's rated 99. So super, super strong stock. Then Quanta Services, the ticker is PWR. That's a key player in both renewable energy infrastructure and AI-powered data centers. Earnings and sales are growing very fast, around 20%. Institutional support is very strong, and it's showing tight action just below a breakout. So, it's in the top sectors this year as well, industrial, and it offers a 6.2% dividend yield as an extra bonus. So, PWR. Then you've got AT&T, A-Tour Lifestyle, AT&T, not AT&T. That's a premium hotel chain targeting China's rising middle class. So it's actually a Chinese stocks, but trading in the US market, quoted in the US market. It's got explosive EPS and EPS growth, high ROE, strong price momentum, and room for more institutional ownership. And there's something interesting and new with this stock in particular, is that the Chinese government is supporting the local economy, supporting domestic travel. So there's this kind of N element that is very appealing for that stocks. I think this one you should also consider buying it. And then you've got KLA Corporation. The ticker is KLAC. It's making precision tools critical to advanced semiconductors manufacturing, especially for AI chips. Growth is strong. It's accelerating. ROE is good. Institutional demand is solid. There's something new as well driving the stock, which is this huge demand from these big clients like TSMC and Samsung, and it's rated 99 on the IBD platform, and the stock is sitting just below a buy point. So also very strong one. And then the last one, Interactive Brokers, IBKR. That's my favorite platform. I'm not sure if I'm allowed to say that, but that's still my favorite platform. It's a global electronic brokerage. It's gaining shares as retail traders are becoming more active, especially in options and international markets. Strong growth, strong EPS. It's compounding at over 30% annually. Strong ROE, excellent price momentum in a leading sector. So top stock as well that fits the CAN/SLIM. So those are the 5 stocks that after doing all of this work, all of these screens, I found right now or fitting the CAN/SLIM method.
Yeah, and you mentioned before starting that list that, these were ones that were super actionable and, most of them right now. I'm curious if there's any stocks that have screened really highly on the method but aren't yet at a buy point.
Yeah, actually, there were 2 groups, really. First, you've got names that are forming proper bases right now. So, they're not actionable yet, but they're setting up nicely and definitely worth watching. So, among these stocks, you've got Argon, AGX. You've got Exxon, AXON, which is actually the manufacturer of the tasers. So, it's kind of becoming a pretty essential infrastructure play for public safety. So, you've got your N element there. You've got the big long-term growth stories. So, quite interesting. Argan, by the way, the stock before is exposed to AI data centers and EV infrastructure for those of you interested. Then you've got Arista Networks, ANET, ANET. It's basically a networking leader at the heart of the AI build-out. And then you've got Welltower. So, that's a REIT, actually. So I picked it because it's in a slightly different sector. But, it's got demographic tailwinds. And to be honest, it's shaping up nicely in a nice base. So those are the ones that I've identified that are scoring highly on CAN/SLIM, but still forming a base. And then you've got the second group, which are, the overextended leaders. So, those are the super strong CAN/SLIM stocks, but they've already broken out. They've already run very hard. So now it's about, waiting for them to reset and form a new base. Of them, NVIDIA, I don't think you'd be very surprised to hear that NVIDIA makes that list. Palantir, Broadcom, Vertiv, they all check the CANSLIM boxes absolutely perfectly, but they've moved too far, too fast. And again, CANSLIM is not just about what to buy, but also when to buy. That's really, really important.
Okay, now, that's a lot to take in. If you're listening and thinking, where do I even start? Well, Steph, you seem to have covered that base in your research too, haven't you? So for those listening who want to implement this, what's step one?
Well, I hope after half an hour listening to that, they know where to start. But no, joke aside, let's just make it very actionable, right? So, I mean, step one, set aside a portion of your portfolio, money you can actually afford to lose. That's super important because it's a high-risk strategy, and use that money to, apply the strategy. So, then go back through the stock list we've just covered and focus only on the names that are still within a proper buy zone when you listen to this or when you read the article. So, again, ideally breaking out of a base with strong volumes and no more than 5% above the breakout point. If the stock has already run too far, let it go, wait for the next setups. You will have some other opportunities. No worries, be happy. When you buy, size your position based on your stop loss and aim to hold at least 5 different names, I would say, to, spread the company specific risk. And then, use automatic stop loss orders 8% below your entry point and consider setting a take profit around 20% to keep things disciplined. And finally, block time once a week to check on your portfolio, update your watch list, and manage your exit. And remember, it's going to be a steep learning curve, but it's the best way to learn is really by doing. So now, just one important warning, I would say. I'm all excited about the strategy. I think this is a great framework. It's super interesting. But I think it's also a very tricky moment for growth investors. Expectations are sky highs, margins of safety are very thin, investors are pretty complacent. We're late in the cycle, growth stocks have already massively outperformed, many names are priced for perfection. So, unless you're managing positions very actively and ready to cut extremely fast, things could go wrong with this strategy. So I think, for those of you a bit more cautious, like personally I have to say, I think it's an interesting time to add a little bit protection, especially if you want to run that strategy. So for example, a very simple move could be to, buy a put spread or a put option on the S&P, for example, with a strike price around 620, 630. If you do that, that would probably allow you to, be a bit safer if things start to turn sour. That would give you a bit extra time to actually, execute your stop losses just in case things go wrong. So I think, now is not a bad time to just have that extra cautious step, especially if you're new to the strategy. So, just a little warning there.
Well, Steph, this has been a super comprehensive overview of this strategy. And for you, our listener, if you want more on this, you can find Steph's full research report over in the app. And of course, all of the other research that Steph has written. So all that's left for me to say is, Steph, thanks so much for coming on. It's been a pleasure.
Guy, always a pleasure. Cheers.